Good morning, everybody. This is Kirk Spano, Investing 2020s. We had some technical difficulties yesterday. My whole neighborhood lost internet for about 5 hours, so I went swimming. Today, I'd like to cover a couple of things that I think are very important, and especially for the newer folks who listen to me. I think that we should consider that some of the ideas that we've always had about investing, or that many people have about investing, are often wrong. And getting away from those wrong ideas is a difficult task for many people because they've incorporated those beliefs into their ideological structures, their just general belief systems, and those are hard to leave behind. Back in 2012, I started talking about how the dollar would eventually become the strongest currency on earth among the large countries, and that it was going on a long-term bull market. This was at a time when everybody was talking about a dollar collapse, something that is perpetual. People talk about a dollar collapse, and they really don't understand the economics of the planet in general, or of the United States in particular. So I'll lay this out again for probably the 100th time at least. The United States, because of our resources, because of our safety, because of our political structure, because of our military, because of our technology, because of our labor force, and on and on and on, property rights, is the strongest economy on earth. We've showed it over and over and over again for multiple generations, not years, but generations. Currencies are relative to each other. The reason why people talk about gold standard, in particular the Russians and the Chinese and some other countries, is that it would level the playing field with the United States on currency. Because if the currencies are backed by the credit and full faith of a nation, then you will focus on the strength of their economy and their systems, the safety and reliability of those countries, the trustworthiness. And that's bad for countries like China and Russia, but it's good for the United States. So for 50 years now, the United States has been issuing debt, not because we needed to, because we could have run balanced budgets for the last 50 years had we chosen to. But we issued debt and spread it around the world, particularly to China, as a matter of geopolitical policy. What do I mean by that? There's over 1 billion people in China. And having them be hungry and cold would have meant they would have been angry, which would have meant that it would have been easy to stoke war. It has long been a foreign policy aim of leaders throughout history, give people a reason not to fight. And a better standard of living is the number one thing that does that. So the United States, to prevent the dollar from getting too strong and to support a policy goal of helping the world grow and get to better standards of living so that there'd be less war, borrowed, kept the dollar in a trading range. Because left to its own devices, the dollar would be incredibly strong, stronger than the Swiss franc, stronger than the yen, stronger than anything. If the dollar is too strong, it hurts the ability of other nations to grow their economy. So by taking on debt, the United States stimulated the growth of the world and improved our own standard of living because our growth rates and our standards of living increased faster than the interest on the debt. That's what was. What is that things are changing now. And yesterday's news from the Bank of Japan was another hint at what was coming. What the Bank of Japan talked about yesterday, which caused the stock market to get angry for an afternoon, was that they were going to begin the process of interest rate normalization. Currently, their 10-year bond trades for below 0.5%. That's actually the cap. And they're starting to remove that cap, and it'll take years because there are a lot of carry trades tied to that. But the reason they're doing it, and Shooter's been tracking this over at Fundamental Trends, is that the yen was starting to weaken after decades of easy money policy. So now Japan is in a position, because of its aging and its shrinking population, that it can allow interest rates to slowly start going up and hopefully not completely destroy the nearly $4 trillion of carry trades that are going on right now. What is a carry trade? A carry trade is when you borrow money from one place to invest it in another place. And if you can borrow money from Japan at close to zero, you can go and invest it somewhere else. The age of borrowing money from Japan at close to zero is just about over. So as their interest rates go from close to zero to close to 1, to probably close to 2 or 3 over the next several years, that means that less money will be invested around the world, the United States in particular, because Japan is normalizing. Does that mean a crash in the US markets? Probably not. Because at the same time, the United States has started reversing their policies to allow our interest rates to settle at slightly higher levels. I believe over the course of the next several years to a decade, you will see US and Japanese interest rates converge, not necessarily match, but get close together in that 2 to 4% range. Why is that important? It's important because, again, we have to go back to the fundamental idea that the United States economy and therefore its currency are incredibly strong. But what about the debt? Remember the scene in The Wolf of Wall Street, pounding on the chest, pounding on the table, people stomping their feet, typing in their blogs. The dollar's going to crash. The United States is doomed. They've been wrong forever. They will continue to be wrong forever. But they'll sell a lot of newsletters, get a lot of people to visit their websites who are scared of change and generally don't understand the fundamental nature, the fundamental trends of the global economy. Unfortunately, that's 4 out of 5 people, so there's a market for that. What I'm telling you is that the United States is on the verge of a super boom. There'll be hiccups. Baby boomer bust, when the last one is on Medicare, is probably the biggest hiccup. But as we've talked about a number of times, the massive stimulus and bailouts during and just after COVID probably pulled forward a lot of the bailouts that were going to be necessary to bail out the boomers. So now suddenly we see that the stock market and the economy are doing well. We learned that GDP was at 2.4% for the last quarter, higher than all expectations. When I was in Las Vegas, I tried to tell you that. Everywhere that I've been this year, everything's been doing well, with the exception of some of the homeless and crime problems that are largely the fault of cowardly or ideologically blind politicians. Today, we saw the PCE deflator come in at 4.1%, which was just a shade below the 4.2% estimate. And I would point you to something that's going to matter in the next quarter. That PCE deflator did not take into account the $30 billion of extra wages going to be paid to Teamsters. And it doesn't account for the probably trillions of dollars more in extra wages going to be paid to all sorts of people across this country over the next several years. Wage inflation is going to continue to outpace core inflation and other measures of inflation. And I would argue that's okay. And I think that at some point, the Fed is going to realize that's okay, because Elizabeth Warren's just going to continue screaming at them. We're about to go into an era where there's essentially no inflation other than wage inflation. And that's really good for a lot of people. Deflation in expenses, but inflation in wages, it'll make profit margins a little tighter. However, spending just keeps happening. AI is going to make things more productive. That's largely where the deflation will come from. But the other place is going to be energy. So as AI lowers the cost of healthcare and energy becomes more abundant due to alternative sources, changing the way we do transportation, changes in the way that we store energy and get energy, healthcare and inflation and energy inflation, 2 of the biggest indicators for inflation, right? 2 giant parts of the economy. And if those go flat and then go into deflation several years out, but wages stay a little higher, it's a recipe for higher standards of living. I would argue that the United States is on the path to balancing their budget almost simply because of those 2 reasons: cheaper energy, cheaper healthcare. The healthcare system in the United States is twice as big as a percentage of the economy, and we have a big economy compared to any other developed economy out there. What if suddenly the healthcare spend in GDP is cut by 20, 30, maybe 40 or 50%, because AI reduces the number of visits it takes to get a proper diagnosis and treatment plan? We already know the technology can do that. There'll be pushback from some of the doctors and hospital systems, but ultimately they will adopt it because the government will say, if you don't, you're toast. So we are about to enter an era where Japan starts to normalize their interest rates because their population is falling and is going to continue to fall. Japan is the roadmap for the United States, not Europe. A few years back, Warren Buffett started investing in brokerages in Japan. My argument was because he anticipated Japan would take a lot of the banking business from Hong Kong after they were invaded by China. In fact, he actually started buying those banks and brokerages in Japan before that invasion happened, because I believe he probably saw that it was coming. A lot of us did. I'm invested in Berkshire Hathaway just to get a piece of the action that he's in on. As interest rates go up in Japan, those banks and brokerages will make more money. In Japan, with a shrinking population, which means less of a need to import goods and commodities, a very industrialized economy, basically turning the commodities they do import into higher margin products, are going to continue to be a powerhouse, and I would say a larger Switzerland. Strong currency, high standards of living. As the population gradually diminishes, the amount of money is split up among fewer people, higher standard of living. And remember, they're getting cheaper energy too. So as energy gets cheaper around the world, there's going to be a lot of impact. Japan's on the leading edge of this industrialized economy, adding a lot to their financial sector. The United States is an even bigger version of that, the biggest. Over time, the United States, with these higher interest rates, again, I don't see interest rates going back to zero in the United States for a very long time, if ever, maybe not again in my lifetime. We've entered a period of normalization. And during this period of normalization, as manufacturing comes back to the United States, as it becomes more mechanized because of AI and machine learning, because we have a lot of resources, you're going to see employment stay tight for a very long time. Eventually, we'll allow immigration, if nothing else, to take care of the aging boomers. So what are some key takeaways here? Well, because inflation in the United States is shifting more than it's falling now, remember, when it was up at 9%, I said it was going to head down towards 3% by the end of this year. And that's essentially where we are. But because the Fed hasn't adjusted for the reality that I just discussed, and they've come around to a lot of the things that I've talked about in the past. Frankly, I think they're right there with me. They just keep their mouth shut, right? Sometimes people who know don't tell. Same reason I don't make a lot of my stock picks public. I don't pound the table a lot. I don't try to convince you. I just put it out there for you to consider and figure out. A few weeks ago, I mentioned Nutrien. Today, somebody asked about gold stocks and steel stocks. And I said, well, I'm not really into commodity stocks in general, but there are certain ones that I like. Freeport-McMoRan is always on my list. But I mentioned Nutrien about 3 weeks ago. It's up 10%. Why? Because there's reasons. Climate change is increasing the need for fertilizer. There hasn't been a lot of investment in potash mines the last decade. And there's a disruption in Ukraine, which provides a lot of the potash for the planet. So Nutrien, after a big correction, is poised to probably retest their highs in the next year or two. We'd originally bought Potash Corp back in the 20s. It merged with Agrium, went up to over 100. We sold it within 2 or 3% of the top. And I said, maybe we'll be able to invest in that again someday. And it came down from in the hundreds to in the 50s, I believe, around 60. I said, buy it. It's 67 today. There are realities. They're just simple realities. Climate change is one of those simple realities. Mega improvements in technology is one of those realities. A changing energy system is one of those realities, which is largely tied to climate change broader, and aging demographics. So one of the trades that I made this week was just to undo a trade I did from a few weeks ago. Is I dumped my TLT because I don't see interest rates falling in the United States this year, and I can do better things with the money. At some point, TLT is going to make a lot of sense. However, if we have to fight inflation one more time, and that would largely be because of short-term energy issues, TLT can go down into the 80s. I just did not want to take that chance. And I know enough companies well enough. I'm good enough at following momentum when it's out there that I didn't need it. I am surprised that the economy is staying as strong as it has, even though I was one of the people who said it would stay strong and that we are entering into a mega boom. And I discussed with a client yesterday on the telephone for about an hour how a lot of things that I talked about in 2020 that I expected in the middle of the decade, 2026, 2027, which were inflection points on EVs and alternative energy, changes in the monetary structure, seem to be happening today, way ahead of schedule. And remember, the things that I've been talking about, 4 out of 5 analysts don't believe are going to happen, and they talk about just the opposite. I'll put my mouth where my money is. I've made a lot of money following my best ideas. I've lost money when I don't, when I listen to other people that are part of the big crowd, part of the narrative crowd. When I listen to people like Jeremy Grantham, or Jim Rogers, Warren Buffett, right? Warren Buffett's almost never in the mainstream. I make money. So I'm always looking for ways to cut risk. I'm always looking for ways to take advantage of the volatility in the market. That's a lesson that you need to have. Use the volatility to your advantage. When you set it and forget it is when you've bought something great, extremely cheap. And now you just have to wait for the market to figure out what you figured out. I've been accused of being 2 years early. I've really tried to make that only 1 year early. Sometimes it is what it is. Sometimes you just need to take the really big view and make sure that you scale in slowly so that when your mile high ideas finally start to come to fruition, you've nibbled in so slow that when you put your big pile of chips in, you do it at a super low price or after the momentum upward has started. So my messages to you are, don't believe the hype on the dollar collapse. It's going to drift down a little bit the next few years, but ultimately, as the millennials proportionally become a larger part of the U.S. economy compared to the boomers, they're already bigger. I don't know that everybody realizes that the millennial generation is bigger than the boomer generation and are the primary earners in the economy now in absolute numbers. The Xers make more money per capita, but there's not a lot of Xers like me, right? Not a lot of 50-year-olds, but a whole bunch of 40-year-olds and 30-year-olds. And the 70-year-olds, right? The boomers who are 60 to 78 years old right now, something like that. First off, they're falling out of the workforce because they're retiring, and a handful are dying already. What's coming is a millennial boom to the economy at a time when aging demographics is actually going to lower our expenses, not raise them. And the linchpin of this, again, is massively falling prices in healthcare because of AI. People say, well, what about all the people? We need to take care of people. Well, at the lower skilled end, it'll be immigration. But you have to remember, it generally takes doctors 3 tries to get the diagnosis and the treatment plan correct. AI does it in 1. It's a lot of time doctors and nurses are going to have freed up to just take care of people instead of putting together a new treatment plan. And the advances in AI are dramatically helping the healthcare industry, from drugs to biotech to devices. That's why we made that one investment a few weeks ago that already has shot up. You can call your doc and ask him about it. All right, so sell TLT if you're afraid that I'm early. I'm afraid that I'm early, but more because there's just better ideas. Interest rates go down a point in the next couple of years, then fine, whatever. TLT will make some money. Look for the crisis. If there's a crisis emerging, buy TLT. I'm going to try to be a little bit more on time with that one. There's a possibility that the bear market everybody talked about doesn't happen until after the presidential election. So while I do think we'll get a slightly stronger dollar here and kind of a corrective moment, it'll be a buyable opportunity. And one of the big themes, at least in the news on Bloomberg, has been a broadening out of the gains from the mega caps to other things, small caps and mid caps in particular. So if the big money managers are talking about that, that means that that's the direction they're moving in. So you can be early, start buying up your best mid cap and small cap ideas. Then when the crowd figures it out, they'll push your prices up. So take a look at our plug and play for stocks. I'm going to add a few more before I leave for vacation at the end of August. And every month we will update the Global Trends ETF with somewhere to rotate to or add to or trim from. We're going to do an update this weekend to update for us deciding to cut our TLT exposure. And again, it might win, but I don't care. I can make more money on other things. I'm more of the mind of Buffett, of avoiding bonds in general and being almost 100% equities. But because I manage other people's money, I have to, gravitate towards that 80-20 portfolio. TLT made some sense. I think that emerging markets debt is going to make sense soon as well, probably after the next little relief rally in the dollar. All right, that's all for today. I'll see you on Monday.